Max, thank you so much for joining me on the show today. It's so great to have you here. We connected after one of my interviews with a previous guest, Paddy from Odin, whom you actually invested in. And in our conversation, I got to learn a little bit more about you. And I knew that I had to have you on the show to talk all about investing, pitch decks, because we've got so many founders, entrepreneurs who are watching this show and who are interested themselves in raising their first fund, their first round for themselves. So thank you so much for coming on the show.
Thank you so much, Nick. Really glad to be here.
So to start off with, I always like to ask guests about their background before they kind of got into what they're doing right now. So can you tell us a little bit about yourself and your background and what led you to where you are today?
Yeah, this could fill up the whole episode, but I'm trying to be brief here. So basically 30 years old right now, based in Berlin, and I've been building and creating businesses, internet projects since I was 15. So started out quite young because I was so excited to learn about the possibilities of the web. So started to build these like little browser games and then moved over to like a more solid business in the education space that I created during my studies. So I studied mechanical engineering, very, very, very far away from the stuff that I'm doing right now. And during that time, I realized that there was so much need in like good education, also for us university students. And back then we created a company that was helping students for their university exams, but also students for their A-levels, and basically bridging the gap between online and offline tutoring. And somehow I ended up with this kind of company and hundreds of freelancers that we were working with, also a team of, at the highest point, around 30 people. And suddenly I was an entrepreneur myself. And since then, I've never changed the track and have like managed to do multiple things, moving out of that business, but also actively investing in around 25 companies all around the globe. And there are a few things that I'm really, really passionate about, and that has been like my main focus for most of the past years. And one thing that really struck me is all around startup fundraising. Because when I first started to raise funding for my edtech company back then, I had really no clue what I was doing. So I did every single mistake. I built a shitty pitch deck and in the end didn't manage to raise funding. And also did a few things that I would suggest not doing. And luckily over time, I managed to learn everything about it. And now this is something that is really like my personal passion, like helping founders to fundraise, talking about pitch decks and all of these things.
Awesome. I love it. This is exactly why I wanted to have you on the show today, Max. Brilliant. So let's maybe get into that then. Let's get straight into the meat of the topic, which is all about pitch decks. How would we start this conversation around pitch decks and, you know, the kind of the top tips that you would have when it comes to structuring a pitch deck for founders who are looking to raise for the first time?
Yeah, that's a really, really good question. And I think we should start one step before that. So I just imagine I'm a founder, I'm creating a new company. And in the past, the first step to creating a new company was always to interview customers, work on my first MVP, and then actually finding like paying customers. And then at some point, you as a founder would realize, okay, we need some more money to really scale our growth and become a real company. And this is a really, really good point to raise funding at. I think like one mistake that I see from a lot of founders, they are starting their company journey with their fundraise. So they are first thinking, okay, I'm raising funding now, and then I'm going to do all of the things that I just talked about. And I think that's really, really difficult to do because in the end, you want to sell, or you need to sell your idea, but also yourself as a founder to the investor. And it's way, way easier if you can actually base all of the things that you are talking about on actual data that you have, or user interviews, first traction, and all of these things. So really, really important to know exactly when to think about fundraising and what things to include. But also, and this brings me to my second thing, is understanding how the whole investment world works. Because when I was first raising funding, I had no clue how the whole venture capital world works. I didn't know what angel investors were, what VCs were, and what also their expectations were. And so I would start as a founder, if I think about fundraising, with understanding this kind of world. So understanding the different types of investors, and we can talk about this later, but also what their expectations are, and then see if this aligns with my personal journey as an entrepreneur or where I see the company in the next few years. And this is almost like the starting point of your whole like fundraising journey, building your pitch deck journey.
Why is it, do you think, that so many founders or, early stage founders, entrepreneurs are thinking, I can't start a business without having raised?
This is a really great question. And I think being an entrepreneur is so different from being someone who works in a regular corporate job, I don't know, consulting or anything, because you are used to get your paycheck every single month. And for me as an entrepreneur, and specifically for me as someone who hasn't worked a day for someone else in my entire life, I was always used to risk. So I knew exactly if I don't earn money this month from my businesses, I don't have a paycheck. So for me, it's not a problem to have this kind of risk because I trust in my abilities and the stuff that I'm doing. And I know exactly if I talk to enough customers, if I build a solution that they love, I will have this kind of money. So on the other hand, I see a lot of people who are starting out their business and they have been in regular jobs before. And I think this is like the more regular path of also becoming an entrepreneur. And they don't want to have a month where they don't get a paycheck. So their thinking always is, okay, if I have raised a round of funding, I can pay myself and then do the nice work of becoming an entrepreneur. And for a lot of people out there, that works out, but this is not my favorite way of doing it from the entrepreneurial standpoint, because I also want to de-risk my journey as an entrepreneur, and also B, from an investor standpoint. So the companies that I'm investing in, I would never invest in a company where the founders are saying, I will take the leap and go full time on this and work on this if we have the investment. Because I say, okay, you have to jump first, and then I'm happy to support you because I want to sit in the same boat together with you. And we have to really paddle hard to get this thing off the ground, because entrepreneurship is always beating the odds.
Yes, totally. That's a great point. When you're on the other side of the table and you're receiving a pitch deck from a potential, from a founder who is looking to raise money, and you come across pitch decks where they're pre-products, not pre-product market fit, but pre-product, does that make massive alarm bells ring in your mind?
No, not at all. I have no problem with like pre-product startups. The only thing that I want to see is some kind of traction. And this is one of the main questions that I get from founders. So how can I show traction if I'm a pre-seed startup or raising an angel round? And my answer to this is, I define traction as everything that you have done since the moment that you started to think about the idea. And this can be user interviews. This can be, I don't know, smoke tests. This can be partnerships that you already built up, or distribution. Everything that will help us on the road or on the journey towards a profitable, sustainable company. And you really have to show these kind of things. And then I will be very, very satisfied as a potential investor.
That's very interesting. When you have a founder who's pitching to you, what do you want to see of them and their let's say early team that they might have? You have solo founders, you have co-founders who are working together. Sometimes there might be something a little bit more fleshed out in terms of a team. What do you need to see in order for you to say, I feel confident with this early stage team that's pitching to me?
Yeah, so I have like three main things that I'm looking at with every kind of startup idea, especially in the early stage. So first of all, around the idea, the general idea and product. So if they are actually successful with the bets that they are taking, will it change the world, and can it be 10 times better than the things that we are seeing in the market right now? And then for me, it's a scale, I don't know, somewhere between 0 and 10. And let's see where on this kind of like scale they are with the thought that they have right now. Second thing is execution. So the things that I just mentioned, everything that they have done since thinking about the idea. And the third thing is the team itself. So This is basically around past accomplishments. And one thing about this is I see in a lot of pitch decks that people are just writing, okay, I was working at Facebook before, or I was working at Google or something. But for me, it's way more important to have very, very specific accomplishments of these people. So I don't know, created a podcast and scaled it to 10,000 viewers per month or something. So really showing off that you started at zero and brought something to a certain point helps me to assess you as a team. And I also want to see that you are very, very different as people in one team. So you can only be successful with your startup journey if you have like some kind of divide and conquer mode, where one person is taking care of the product, one person is taking care of marketing, and one person, I don't know, is taking care of finance or something. And in my past companies, I made the mistake over and over again that we as early stage founders, we were all doing everything. And this is like the worst thing that you can do. Every founder was involved in every decision, and that slows you down in a way that's insane. So right now, I would always try to be laser focused on the things that I can do on my own and the things that my co-founders can do.
How do you feel about solo founders versus co-founders? Do you like to have co-founders who are pitching to you as opposed to just a founder who doesn't have a supporting partner in the endeavor?
Yeah, so I don't know what the latest statistics say. I think there is some kind of statistic that says that co-founding teams are performing better than solo founders, but you shouldn't have too many people in your co-founding team. But just from my gut feel, I know the journey of an entrepreneur is always this kind of roller coaster ride. So in the press, you only see the nice things that are happening, but behind the curtain, there's so much shit that hits the fan. And it's always good to have someone at your side that you can share these kind of like bad moments with, and then you can push yourself towards coming up again. So I always prefer to have co-founding teams.
There's a kind of a typical structure that we come across around pitch decks. And, I've reviewed some of your own material and a video of yours where you talk about a structure that a lot of people go with, and it's that sort of title, problem, solution, TAM slide. Can we maybe talk about that? And, that maybe even that first slide, that title slide, because that can sort of really set the tone of what's going to come in the rest of a pitch. What are your kind of top tips around that title slide?
Yeah, 100%. So if I think about the title slide or even the pitch deck in general, it's about getting us the foot in the door. Just by having a good pitch deck, you will not get an investment. But probably if you have a really good pitch deck and a good title slide, you will have the conversation with the investor, and then you can persuade them to invest in your company. So you have to make sure that it's really outstanding when it comes to design. No one wants to see these like very, very ugly slides because they will go right to the bin. Second thing on the title slide is I want to know what the business is about in, 5 to maximum 10 words. So try to really create a value proposition or headline that is really, really catchy, and where I as an investor can see, okay, it's this headless e-commerce software that increases your speed of your e-commerce store by tenfold or something. I know exactly, okay, this is nice, I want to see it, this fits my thesis, and let's go. And besides that, obviously include your logo and also your contact information so that they can reach out to you right away or look at your LinkedIn or something.
Moving then onto that problem slide, entrepreneurs are in the game because there's a big opportunity that they're trying to take on. It's a big problem or it's a big opportunity, one and the same in many cases. And this slide for me, I always think is very important from pitch decks that I've seen and pitches that I've given. Can you talk to us about your tips and the things that you've seen in to get the most from a good problem slide?
Yeah, so the best problem slides really show that the problem is very, very specific. So no one wants to see 10 different problems that the people have. I would rather like to see like one sentence that nails it down. And the second thing is, if you can underlie it with data, that this kind of pressing problem exists for a lot of people, that is also quite helpful. But I would rather go for a problem that a few people have, but it's really, really pressing, than having this broad problem that could be relevant for everything. Because most really, really good businesses start in some kind of niche and then grow out of that niche. And it's really important to show that you actually understand the customer better than anybody else.
You raise a really interesting point there, and it's about that. I'm using different words to describe, I think, the same thing, which is this land and expand that a lot of startups have. You know, at the early stage, if you're laser focused on one particular thing, I think a lot of founders can feel, well, oh, that's not a big enough opportunity for investors. You know, we can't grow a unicorn business out of just targeting this one particular thing. But I suppose what you're saying is that it's not always just about that. An early stage investor can actually see, you know, this seed and this land and expand will take place naturally, but you have to be laser focused about that first seed that you're planting.
100%. And for example, something we could think about would be Loom, like the video recorder. Let's imagine we are creating a company like Loom. And this is a solution that could be literally helpful for anyone that is in the working world out there. But if I have a persona or an ideal customer profile that is so broad, I don't know where to start. Like, what kind of features should I build in terms of like product development, or what kind of marketing materials should I build? So if I would create a company that is like Loom, I would be laser focused on one persona first. For example, sales reps that are recording outreach videos or something. Then trying to build the best product for them, trying to build the best marketing collateral for them. And if I'm very, very successful at this, I have a business that is already running and that is generating revenue. And also I have a product that is like 10 times better than what I had at the start. And now I can move over to other categories like customer support, for example, or development, and actually create this kind of big company. And what most founders always like do like wrongly, in my opinion, is they compare their startup in the first hours to the companies that they are seeing out there that have been in the market for 10 years. So if I am comparing my startup right now to a Loom, for example, I need to compare it to a Loom that is on the market for a month or 2 months or half a year or something. And at that time, they weren't serving all of the people out there.
Are founders concerned about that because of, sort of playing devil's advocate here, because of the fear that investors will say, well, you need to be 10x better than the competition. So therefore, they are comparing apples with oranges. It's not the same thing, but the founders themselves are worried that this is going to be pushback that they're going to be receiving from potential investors.
So I would always like, if you have a good go-to-market strategy and also product development strategy, you will have great numbers, and great numbers beat every kind of like opinion that any kind of investor might have, and will always be the most persuasive thing out there. And the second thing is like, talking to investors is not about having them agree to everything that you say. It's okay to have a different opinion than someone out there. You just have to like really show off that you are the expert in that market and you have a really, really good reasoning to do all of these things. So don't take any kind of pushback for them and then change the direction of your business if you actually have a good plan yourself.
So moving then from that problem slide to the solution slide, what are some of the slides that you've seen, or the kind of themes of a good solution slide that tend to win over investors?
How I would do it is I would always divide the solution and the product slide, or solution/feature slide. So with a solution, I'm just trying to very, very specific on how I envision the world with my kind of product or solution and how it actually solves the problem that I described before. So this could be, I don't know, the problem is it's hard to find cheap hotels. And the solution for me could be, hey, I'm building a marketplace where people can rent out their air mattresses to really have like a cheaper way of traveling a new city or something. And just
heard of a business that did something like that in their original pitch deck. Can't remember the name now.
And then, so have the problem first, then high-level solution, and then you can go over in detail and talk about the actual product.
Okay. So then in that solution slide, should there be metrics or proposed quantifiable benefits that a user or a customer would receive as a result of using this product there, even if, let's say, it's an early stage founder, early stage company, and they might just have an MVP out the door, and they're talking about what could be achieved, or should they just kind of stay away from prospective metrics at that point?
Yeah. So the good thing about pitch decks is that there is no right or wrong, and also that you have to adjust everything that I say for your specific business. If you feel like, hey, the slide is getting better if you add metrics, that's great. If you feel like, okay, the metrics that I'm putting in here are actually useless, it might be a better idea to leave them out. And
okay,
never just try to fill any kind of slides with useless stuff, because every investor that scrolls through tens of decks per day will see it right away. And if you as a founder can already sense it, they will also sense it. So no bullshit metrics.
Okay. Moving then on to the features slide, or maybe the demo, if you will. What works best there from your experience?
It really depends on the kind of business you are building, but I would always try to include any kind of mock-ups, product screenshots, or anything that people can look at, and it needs to look fancy. And even if you don't have a product yet, just try to build out some mock-ups in Figma or something. No one will ever know if the product exists in that specifics already. And then it's just about like pitching your solution. So why is it actually cool to use your solution, and why would you as a user use the solution? And if you compare that with the value that your customer gets out of this, it's insanely good. So let's jump back to the example of the headless e-commerce storefront. So you could say on the features, hey, you can build your store way quicker. The loading time is 10 times faster, and this results into an increase in conversion rate of 30% or something. This is crystal clear. Everyone knows, okay, if I can increase my conversion rate at 30%, it's a business that everyone wants to buy or use.
How important is a real working demo for investors? I say this because in most cases, potential investors are not going to be the end users or the prospective customers of the thing that's being pitched to them. So, playing devil's advocate again here, should even a demo be there at all?
So I think it really depends on the stage that you are in. I would say for most investments that I have seen at Series A and before, no investor will not even create an account or something or click through anything in your product. So if there are some fancy screenshots, that's more than enough. But in the end, and this is also really, really important, fundraising just helps you, or like investments in general, just helps you to build something that is working for the end user. And it's just like a way to get the things done. I would always try to build an outstanding product first, and then everything else will come. Because the best type of funding will always be customers' revenue.
Yep, and that comes with no equity being given away in exchange. Moving on then to the market slide. This is a slide which I think there's a lot of debate around and around the total addressable market. Can you talk to us a little bit about the market slide and what founders should do and what they definitely shouldn't do?
Yeah, so I think the market slide is one of the not so important slides in most decks, especially in the earliest days, because you can write down any fictional numbers that you can find online or something, but in the end, it's more of a homework that you are doing as a founder. So about writing down where you see yourself positioned in the market and which the incumbents are that are already active in the market. So for example, if I'm looking, let's say we want to sell paint as a direct-to-consumer brand or something, I would look at all the paint that is sold at Home Depot and all of these kind of stores and see how much revenue that they are generating or how many people are actually buying paint. And this helps me to see if my business can actually grow to a size that could be relevant for any kind of investor. But what I wouldn't do at all is these kind of calculations where you say, okay, the total market is 200 billion, the European market is 50 billion, and I'm taking 10% out of it. So where does the 10% come from? This is just a fictional number, and I wouldn't include something like that.
How do you recommend founders go bottom up then in terms of their addressable market? Because let's say if they're building a very niche product, maybe let's use that example that we talked about earlier on with respect to a Loom for sales development agents. If a founder is coming to pitching something like this, how do you recommend that they go about, valuing the market that they're going after? Because that information may not be, explicitly there for a tool which is quite niche.
Yeah, but I would say, like with this specific use case, I would do some research on how many sales reps are actually working in the, Germany, US, Europe, however, and then I would end up at some kind of like really, really large number. Millions of sales reps will be out there. And then what I would do is I would do some research on what other tools are charging in that space for, mail outreach, for example, or LinkedIn outreach. And you will see, a mail cold outreach tool for mailing will be at $100 per seat per month or something. And my assumption here, or my core bet, and you can even write that down, is that a lot of sales reps will use video instead of mail in the future. So I would assume that like almost everyone needs to have a video tool inside their sales stack. So let's just use the millions of sales reps out there, multiply it with the, let's say, $49 or $99 that we are charging for our tool, and then we end up at a really, really nice number.
Earlier on, when we were talking about the market slide, you were talking about competitors. Do you think the market slide is that best slide to introduce the competitors, or should competitors be in a different slide? And the second question that follows on from that is, how deep should a founder go into the competitors? How deep into the weeds is too much information, or what is it that an investor is happy to see?
Yeah. So first question, market and competitor slide are, in my opinion, two different slides. There are some businesses where it makes sense to combine them, but in 90% of the cases, these are two slides, where the market slide just shows, okay, it's an opportunity here, and it's worth that we are talking about this. And this is especially useful for VC funding in general, because the VC model works in a way that they need to invest into businesses that can become really, really big. And really big means there needs to be market sizes way above 1 billion for the market you are in, because otherwise it wouldn't make sense for them to invest at all. And the competition slide is more about, okay, let's see, we are a tool where we do these sales videos, and our competitors are generalists, for example, a Loom out there. And on the other hand, there would be tools like, Apollo. They are doing mail outreach, and they are moving into the direction of video or something. And it's really important to position yourself somewhere on that kind of scale, and most likely also talk about why you are better at certain things, and also where are you going with your company, and why are you different? So why should somebody buy from you instead of all the others? And these can be really, really good, like bullet points or something that persuade the investor.
The go-to-market strategy and the presentation of that. What are some of the things that you've seen work versus not working?
Yeah. So first of all, it's funny that in, I would say, 70 to 80% of the decks that I get, I don't find any kind of go-to-market slide. And this is always one of my first questions, because what I have learned as an entrepreneur over the last 15 years, you can build the best product. If you have no distribution, you won't be successful. And I made the mistake over and over again, because I'm also a product guy and I love to build product, sit here with my friends coding and building fancy stuff. And then the website is up and, no customers on the website because we have no distribution. And this is the reason why so many startups fail. So if I'm building a business right now, I'm always trying to think about the distribution first, and then I can start to think about building the business. In terms of go-to-market slide, what does that actually mean? First of all, things that don't work is if you say something like, we are doing social media, we are doing PR, we are doing cold outbound, just lining up every kind of possibilities that you have for the future, because you as a founder and also as a founding team will always have unlimited ideas but limited resources. That means you can't handle all of these channels at once if you are starting out. You have to be laser focused on one or maximum two channels. And the most successful businesses that I have seen have even grown to way above 1 million in revenue just by being really good and owning one channel. So for you, that means you can do a few very, very small experiments and see which channel might be the best one for you. But afterwards, all of the resources focusing on one channel and then growing the business. And the go-to-market slide really lines out this kind of strategy on why you are using this kind of channel to do it.
How many, when you're looking at that slide and you're having that conversation with that founder about go-to-market, how many channels are your sort of cutoff for you saying, okay, this is actually unrealistic? You're not going to be able to pursue that many channels simultaneously.
I mean, you can persuade me otherwise, but I would say in a pre-seed or seed startup, if you have more than two channels, I want to know exactly who is actually taking care of these channels. Because in most of the cases, it still needs to be one of the founders or CMO or something. And anyone who has worked in this industry before knows exactly that it's so hard to juggle 10 balls in parallel. And in 99% of the cases, you will end up worse than just focusing on one channel, owning this channel and bringing it to a certain size. And then you can add something on top if you actually have managed to own the channel.
I think that's great advice. Moving then on to roadmap. This is a slide which is very popular, and I would say most people would say is pretty crucial to be in any sort of pitch deck. What the company plans to do over the coming 12, 18, 24 months. What are some of the top tips that you'd have for founders when it comes to the roadmap slide?
Yeah, so I think the roadmap is important because of two things. First one is the investor wants to know where his or her money is spent on. And the best teams know exactly, okay, we are raising $2 million and we are going to spend it on X, Y, and Z because we think, okay, this is where we have the biggest lever. And it also, they add the information on top of it where the money will bring you. So for example, if we are investing these 2 million into hiring 10 A+ engineers, trying 25 marketing experiments and building out the product to this version, we will be at 500K annual recurring revenue or something. This is where I, as an investor, say, okay, got it. They have a plan. Here, you can have my money and just go for it. And everyone knows that the plan will change over time, but it's good if you actually have made this kind of homework. So this is the first thing. And the second thing around the roadmap is, and this is why I would always try to also have a longer time horizon, is giving some vision or inspiration, like your North Star metric. So you will be very, very focused for the next 12 months in building this kind of feature out. But on the horizon, 5 or 10 years from now, we want to be this company that runs all of the air mattresses in the world or something. And this is what really sparks up the investor.
Should that slide have both a roadmap for the features and the capabilities of the product as well as the business roadmap, or should those be separate?
In general, if you think any of your slides is too specific, just add it to the appendix, because in the end, a pitch deck will be looked at for around 3 to 4 minutes by an investor. And a good pitch deck is always about leaving out as much information as possible, because it helps focus the investor on what's relevant. So to answer your question, no, I wouldn't include any kind of like business specifics, any kind of product features that you are building out over time, if they are not highly relevant to this kind of investment use case. You can put all of the things in the appendix, but in general, a roadmap should be more high level, few bullets, and then your big vision.
This slide then I have a question about is with respect to financials. So for many companies who are looking to raise their pre-seed or their first round, they don't have much, let's say, traction in terms of maybe customers or users. Revenue might be something that they're going to be looking at a later point. When it comes to financial projections, should that be something that is detailed? And again, I appreciate that this is, in many cases, very much projections. Or is this something that should be avoided by early stage founders?
Yeah. This is really funny because there was just like a huge discussion on LinkedIn and Twitter if you should have financials at all for an early stage startup. And a lot of people out there are saying, no, you shouldn't have any kind of financials because you as an investor are investing in the people and they know what they are doing with the money. But I'm a big advocate for actually having financials from day one, or at least it's assumptions. Because for me, it's also a homework for you as a founder. And it doesn't need to be very, very detailed, but let's just imagine we are building out a financial model for our early stage company. So I would, on the one hand, have our revenues that show how our business is growing over the next month and years. And what do I need for this? I need to have information on my pricing strategy, and I have to have information on my assumptions. Where do I get my customers from? And if I actually write down these assumptions, this helps me to understand my growth engine and how my company will evolve over time. And it's okay if I'm realizing, okay, my customer acquisition cost is not $5 through Facebook, but it's $10. But it helps me to actually start to think about all of these things. And the second element of my financial model is my costs. And I need to know exactly what I'm spending my money on, because otherwise I will end up with burning through all of the cash that I get and then realizing, oh shit, my runway is only 2 months left and now I can't raise any like follow-on funding or something. And running out of cash is one of the, I would say, top 3 reasons why startups actually fail. So make sure to have a financial model, at least like a very basic one that you are putting in your assumptions, but also your like assumptions in terms of revenue, but also assumptions in terms of costs.
That's very interesting. It raises a question for me in my mind with respect to that runway that you were discussing. And should founders be, even if they believe it or not, should they be pitching to investors that, hey, with this round of investment, we expect to break even within, before the runway runs out? Or should they be very frank and say, we are not confident to breaking even by the time the runway runs out, and that really this is just seeing us through until we reach a point to raise again in 12 to 18 months' time?
Yeah, very, very good question. And one of my major mistakes in the past, we were thinking, we are just going to raise one round of funding and then we will be profitable. And this was like so stupid. It's insane. No VC ever that is investing early stage will expect you to become profitable after one round of funding. And second thing is, you will actually ramp up your costs in a way it's insane, and you will never hit your goals in terms of revenue, at least not in 95% of the cases. So you will always end up with this kind of like split when it comes to your financial model, and you will always need more cash than expected. And the second thing is, investors are always incentivized to build really, really big companies. So they are not interested in building a profitable company after 1 or 2 years. So they will always push you really, really hard to grow as quickly as possible. And if you come close to profitability in the first, years or something, they will still say, hey, can we put more like gas in the fire or fuel in the fire to grow more quickly? And so the short answer to your question is no. Like, if you put in your deck that you will profitable, I think this could be already a red flag for some of the investors out there.
That's very interesting. So the kind of business that you're looking to operate is actually not enticing enough for prospective investors because it doesn't fit inside of their model. I think that's a really interesting point, and it goes back to that old adage of, be aware of the audience that you're talking to. That's great advice. Then moving on to the I suppose the end of the deck. What other slides do you like to see in a presentation that we haven't covered so far?
Yeah, so I think there are two slides that are quite important. So first one is the team slide. Obviously, we talked a little bit about this before. Be very specific about who covers which areas inside of your company, what your past accomplishments are, and what your unfair advantage is compared to other teams out there. And then we have another
question, Max. I'm sorry to cut in here, but there's something with respect to the team slide which I'm curious about your perspective on, and that's with regard to advisors. A lot of founders like to put advisors into the sort of team slide as well, and I get differing feedback or thoughts from investors around that slide as to whether the advisors should sit there. Because sometimes the feeling is, well, advisors aren't actually working on the company, and anybody can have advisors on their slides, but actually what good are they really contributing to the company itself? What are your thoughts on advisors and where they maybe should sit inside of the deck?
Yeah, so my personal thought about this is they shouldn't be in the deck at all. Because in the end, if shit hits the fan, it's about the founding team that needs to execute on the idea and really get the business going, and there won't be any advisor sitting there 24/7 hustling to get the idea off the ground. And so I would rather focus and give more space to the actual founding team than any kind of any advisors out there.
Brilliant. Okay, sorry, I'll hand back over to you. You were touching upon the end points of the team.
Yeah, the last slide that I would include is a why now slide that really relates to why is now actually a great time to build this kind of company. And in most cases, this could be because there is any kind of shift in regulations, behavior, or even technology. So for example, a lot of the AI empowered companies are only possible now because the technology evolved so fast. Or another example could be here in Germany, we had this kind of thing where you could only travel long distance by train because there was a big regulation. And at some point, they opened up this regulation, and now you could go also with private buses from A to B, long distance buses. And so there were these guys from Munich that created a company that's called Flixbus. And it's now, I don't know, maybe even a decacorn or something, because they built up this private company with the bus trips, long distance, and really, really successful at it. And so make sure to include a why now slide to show why now is a great time to build the company and why you.
You're saying about technology and about, let's say, legislation. Would another compelling why now also be just trends, consumer trends, business trends, market trends, and that now that has opened up the opportunity for this particular solution?
100%. Could also be something like when you talk about trends, I don't know, in the past people didn't like subscriptions. No, now they love subscriptions. And instead of going and to get your cereals every single day at the supermarket, just now you can do cereal subscriptions because there was a change in behavior on how the people like to have their stuff.
What then should be the final slide in any good deck?
Yeah, the final slide will probably be some kind of call to action slide. So finish off with how the investors can actually contact you, and also have a clear call to action where you say something like, hey, do you want to change the world of cereals together with us, so that they can really take action right away.
Awesome. the deck, let's say somebody's followed this fantastic advice, they've put together this great deck. How public or open should they be with that deck? As in, should it just be bound in an NDA and only hand delivered to a prospective investor? I'm being facetious here, of course. Or should it be, publicly posted to LinkedIn for anybody to see? What are your thoughts around that?
Yeah, so first thought, like no investor will ever sign an NDA if they are actually doing this full time, because they are seeing so many ideas and they couldn't care less about someone who comes around the corner and wants to have an NDA signed, because in the end, ideas are worthless. It's about the execution of the ideas. So in my understanding, you can be quite open with your deck. I wouldn't post it on LinkedIn because I want to have the control about my fundraise and the people that I send my deck to, especially when it comes to timing, because a really, really good timed fundraise is talking to many investors at the same time, because then I get interest from different parties, and then I can just use this as a kind of like leverage to find the best deal. And one final thought about this: if you are sending a deck to someone, you can be almost 100% sure that they will forward it to any fellow investors. And a lot of the people out there will probably see your deck if you are an interesting company in, like, I don't know, a few hours or a few days if you are actually doing a good job here.
What are your tips around, connecting with the right investor for your particular company at your particular stage?
Yeah. So a good fundraise is about preparation. So before you go out and talk to investors out there, you have to prepare your material, and that means your pitch deck, your financial model, and also any kind of like frequently asked questions that you might get. And then you are going to create a long list of investors, and you can research them through the people that you already know, fellow founders, networks, but also websites. And you can see, for example, investor A likes to invest into direct-to-consumer companies at seed stage. So this is someone who is really, really interesting for you. You put them in a like investor CRM, Notion file, whatever, and then you do some research on every single investor and give them a priority for yourself. So high priority means, okay, I really, really, really want to have them on my cap table at some point. And the low priority means, okay, if I don't find any other investor, I will probably take them just because of their money. And then you are doing two things. You are starting to do the first outreach to the investors that are low or mid priority, because you are warming up to get in the game, trying to improve your deck over time. And if you feel comfortable that you are getting some traction with them, then you are going out and talk to the high priority investors. And in the end, it's almost like a full-time job. For a certain amount of time, you end up with talking to many investors in parallel and get the first commitments, maybe the first term sheets. And then it's your time to really stay in control and say, okay, dear fellow investors, we have this kind of like term sheet. If you want to participate in the round, you have time till next Wednesday or something. And if you are not committing anything, you will be out of the process. And this is what really drives a good fundraise, because you have to create this fear of missing out around investors. And in the end, the best fundraisers are really, really short, because then you can go back to actually building your business.
Really, really short. Everybody wants to raise money as quickly as possible. What do you think is a decently timed, or the window, that period of time it takes to raise a round rather, within a short period of time? What would be a kind of a healthy time period?
Yeah, so the best companies that already have some kind of network can probably raise a round of funding in, I don't know, 2 weeks preparation, 2 weeks reaching out, and then 1 or 2 weeks closing. So I don't know, somewhere 2 to, let's say, 5 weeks. The normal time frame would be probably more between 1 to 3 months or something. And everything that is above this kind of number, it's not really, really good, and the fundraise drags over time, and you don't want to have that. And there's one really interesting thing that you said. Everyone wants to raise fast. And I don't think so, because everyone out there, or a lot of people out there, try to maximize the valuation. And this sometimes goes against raising fast. And in my experience, the best founders, they would take a valuation that is a little bit lower if they can actually raise faster. And founders that are maybe doing it for the first time, or that are trying to optimize on the valuation, will say, oh no, I'm not going to take any check under, I don't know, 10 million valuation. And then it can happen real quickly that your whole fundraise drags out because everyone is jumping out of the process.
Yeah. It's just taken too long. And the investors have moved on because they need to deploy their capital as soon as they can.
Yeah.
I have one final question. That's with respect to the appropriateness of particular types of investors for particular stages and particular types of companies. And that is to say, when is it that a entrepreneur should look to go towards the angel route versus the VC route when it comes to raising their round?
Yeah. So first of all, like angels and VCs are very, very different in what they invest in terms of stage, but also the ticket size and also what their expectations are. So if you are starting out to build a company, I would always suggest raising from angels first, because you don't know exactly what your product will look like. You don't know exactly if this is actually solving a really, really pressing problem. And in the end, you don't want to have the situation where you took on pre-seed investors in your first round, then burn through the whole cash, but you haven't found any product market fit. Because then you are looking for a follow-on investment from other VCs, for example, and they will always ask, okay, what about the VCs that have already invested? Will they also participate in the round? And if they say yes, it could be okay, and you will get this kind of funding. But if the VCs say no, we don't want to invest into the company again, the new investors will say, okay, there's something off here. There's a red flag. So why aren't they doing it? And you don't have this kind of signaling risk if you are actually taking angel investors on board, because they are investing their own money. And in 99% of the cases, that's quite limited.
I lied, Max, when I said I had one final question, because this is now my final question, and that is with respect to bootstrapping. I think a lot of what you've built, you've bootstrapped, and a lot of great companies out there are bootstrapped. When is it that you think it's appropriate to say, okay, I'm not going to be pitching to anybody. I'm going to do this myself. We're gonna progress with cash which we're all organically generating from within the business, and we're going to bootstrap. What would be your advice around that?
Yeah, so for me, and I said it earlier, the truest form of entrepreneurship and revenue is revenue, or like cash is cash that is coming from your customers. If you can actually build a company that is financed by your actual customers, this is amazing, great, it's insane. Also for you as an entrepreneur. But there are some businesses out there, you can't bootstrap them, and if you want to actually conquer the world, you need some cash from VCs or investors in general. But make sure that the company that you are working on is a real venture capital case. Because in the past, one of my companies, we raised money from VCs, but the company itself or our strategy wasn't a real VC case, to be honest. And you don't want to end up in a situation where you are having a company that isn't a VC case, but you have VCs on board, because then you will always have some kind of hard discussions around, should we invest into growth, or how can we actually try to take a coin flip or something here. And so for you as a founder, it's really important to know, do I want to grow as quickly as possible and run as fast as possible to make this a $100 million company, a $1 billion company? And if that is not the case, most of the time, bootstrapping is the better solution.
I think that is fantastic advice for us to wrap up our conversation together. Max, it has been such a pleasure having you on the show today. Your wealth of experience has shown through in this conversation, and I think you've given a fantastic outline of how to build a wonderful pitch deck. So Max, thank you so much for coming on the show today.
Thank you so much, Nick. This was fun.